Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go and dive into using the real estate market to basically time your purchases to some degree. Someone had asked a question. He's a platinum member, and I want to answer his question. It's dealing with velocity and how to turn your money over quicker than what maybe someone else could do in the cycle if they didn't know the cycle as well. I am going to say it is more difficult to do this, but you're going to have to get better and better at learning how these assets perform in certain market conditions. So I'll read the question. You guys can get the question, and I've got a lot of data here to try to describe how I view the investment world. I know it's very different than everyone else, and I know a lot of people say you can't time the market. I agree with that. You cannot time the short-term market movements given um, given emotional and news and all these different responses that humans have to the markets. What I'm doing is a strategy that is different than that. And I'm going to describe the strategy, describe a lot of these different market conditions where assets get priced differently. And that is where you need to become an expert in. You need to become an expert in how do humans behave under certain market conditions, and then understanding when the market conditions are changing. Remember the three pillars I have. The three pillars I set up in the beginning of all this. The three pillars are, just to go over it again, market conditions, ratios, and technical analysis. There's a reason I chose these three and went and dug into these three. Market conditions are what changes the pricing of assets. If someone is in an abundant world of water, water is cheap. It's free, so to speak, in most societies. Water is not free when you are traveling across the desert, ran out of water, and will pay anything to get and obtain more water. That is the market condition. Assets get priced differently based off of the conditions that people are subject to. Ratios tell us an objective measurement or way to see if something is cheap compared to history. And technical analysis is a way to gauge if things are changing. It's an objective way to gauge how humans are responding and to do it in an unbiased approach. I don't need news. I don't need someone else's opinion. It's an unbiased way to say, yes, this is bottoming. Yes, this is topping. Yes, this is cheap using the ratios. Yes, this is expensive. Yes, these assets are changing. Yes, we're validating that the market conditions are, in fact, changing for these various reasons, etc., etc. So that's the three pillars. That is what I use to objectively figure out where we are in the cycle. You need to know the real estate cycle inside and out. So if I were to paint a picture of what you need to understand in order to increase, quote, the velocity of cycling through assets, that is changing from one asset to another, you need to become an expert on the real estate cycle, and you need to become an expert on market conditions and how these conditions change under certain market, under the cycle of the real estate market. Another thing that you have to be an expert in is when you see certain responses by the Federal Reserve or you see certain responses by the participants in the markets, you need to be able to understand we've got tailwinds here for these assets. I am seeing a rotation here, and this asset performs the best in the beginning of that market rotation. Then this next asset does very well mid-cycle. And then this late entry, last portion of this cycle in the expansionary phase, which is called a late cycle performer, this is what will outperform. You need to know exactly where we are in the cycle and what performs well when. If you want to try to play the markets as best as possible. You will still be in these assets for some years. They will not be a week or two or three. You'll be in them for years. But it could maybe it's only a year or two. Then you swap. Year or two. Then you swap, or something on the lines of that. It might be a year or two in the beginning of a certain asset, and then you swap it to something else, and you're in that for 5 years. Then you swap to something else for a year or two. Then you swap to something else at the bottom. Then you swap again to something else. Now, I don't think that every cycle is going to be exactly the same, and I don't think the responses are going to be the same by the Federal Reserve for every single part of every single cycle. Maybe they are. Lucky for us if they are, but I'm not sure if that's necessarily the case. So let me dive in here. Let me give you my financial opinions on all this stuff. Again, my paradigm or my viewpoint is from the three pillars that I just described, and I'm going to go through a bunch more information to let you guys know why this works, the why behind it, and what other people have studied looking at these cycles. I don't know all of the cycles. There are multiple cycles. I'm focusing on the real estate cycle, which is AKA the business cycle. There are other longer term cycles that overlay with this as well that can disrupt the business cycle to some degree. So we could have a very long cycle before it that's disinflationary that the real estate cycle falls in. And we've got other cycles where it's inflationary where the real estate cycle falls in. But I think that's more related to the demographics. So demographics are ultimately the ultimate driver of all of this. So let's go in here. Let's take a look, and I'll read you the question that the guy had and get you guys all figured out here. So it says, consider projecting physical precious metals into the mix as well, as they are, depending on the metal, negatively correlated. Wouldn't they increase the, quote, velocity and the potential decrease the time horizon, as you wouldn't have to wait on the dynamics of the stocks? You do have a tendency when using ratios to appear to be timing too close to the highs and too close to the bottom. But if you're able to use objective data to do this, so be it. And that is what's going to determine how good you are, is the timing of the highs and the lows. I do think that we can objectively time it pretty well, but not perfectly well. All that's going to do is perhaps decrease your potential returns. Another thing that I'll say is you could also use stocks or companies that are more leveraged than what I used in that previous example of the ratio game where I turned $100,000 into something that could be tens of millions or maybe even hundreds of millions of dollars over a period of, let's say, 20, 25 years. So how do you do it? What's the whole deal? So this is what you need to become an expert on. So this is the real estate cycle. There are 4 phases. I'm just going to go over it really quick just to get everyone up to speed. The 4 cycles are, or the 4 phases are recovery, expansion, hypersupply, recession. You can tell where we are in the cycle using housing starts or inventory levels. Very low inventory levels are going to be at this middle diamond, right there, the long-term occupancy average. Very low inventories right around this because that's where inventories really start to decline. They go to a level that is very low, and then we go into an expansion phase where new homes are constructed. That is AKA declining vacancy and new construction. We go in and we overproduce too much into a hypersupply phase where our inventories are filled with new homes. We have an increasing vacancy, new construction is high, and that is what causes the hypersupply. We go into a recession because we've built too many homes and overwhelmed the demand. It's even more amplified if you have forced selling at the top, which is a bunch of foreclosures. We go into recession, we've got increasing vacancy, more completions, and we have to go through back into a recovery phase where we recover from that recession. And we have to start the cycle again over and over. A lot of people call this the business cycle. So they are interchangeable. The real estate cycle is the business cycle. And we look at those 4 phases. Every single phase has specific investments that outperform in this cycle. This cycle here, from bottom all the way through back to bottom, is on average 18.6 years. If you want to be a very good investor, you need to understand this cycle inside and out. Here are the four phases, and here are some of the potential outperformers. When I talk about technology in the beginning, this is a recovery phase here. They call it expansion. Yes, we can determine some of these. They call it recovery expansion. I overlap the recovery as long-term average. So some of these are going to overlap with expansion and recovery, in my opinion. So in a recovery phase, real estate and industrials are the outperformers. Generally, when you get to a contraction phase at the bottom, right at the beginning of a recovery phase, they generally print money. And the first asset that I have found to react to that money printing is precious metals. If they were to do stimulus, precious metals generally go up dramatically in the beginning of a recovery phase. Think of this as 2009 to 2011. A lot of the times, since we've overproduced and inflation and interest rates are low, gold does a outperformance, and generally, sometimes, not always, it's the physical metals that outperform a lot of the time during that move. In the beginning of an expansionary phase, if they were to do that stimulus like we did in 2020, then some of the stocks can perform quite well. And it's also true that sometimes some of the royalty companies and stuff like that perform very well during that stimulus phase. So real estate does really well. That's what has bombed out, and that is what's recovering. That is generally what turns first. Real estate is the driver of all of it. And the recovery in real estate is going to drive all the other sectors. So industrials and real estate, they're kind of tied together. Then when the recovery phase starts going, information technology, financials, communications, consumer discretionary. Think of that as technology stocks. They generally do very well in this phase. So you'd almost want to get a crash, which at the bottom of the crash, if they were to stimulate, gold, silver do very well. You swap into real estate after you get that big move up. So you get a revaluation of the physical metals. Boom, you swap over to real estate. You get that going. Then you can also swap back into technology stocks. So you go into gold, silver, then you swap. You're in there for a year or two. You swap into either technology stocks or real estate, whichever one you prefer. I prefer real estate, but you can go into tech as well. You ride that up during the recovery phase. Then when you hit to an expansion phase and you get a mid-cycle wobble, if there is one, there typically is, that is where you might want to swap into energy stocks. Energy stocks do very well in that phase. So you swap into energy. This is where your outperformers are: financials, energy, and materials. So that does very well in, quote, what is a late cycle investment. So that does very well. You start to come into a later cycle investment here. Your outperformers: healthcare, consumer staples, and utilities. Energy goes all the way out to like the end here. Then when you go into this bottoming move, I prefer bonds. That's where, if the housing market is done, where we overbuild and go into a hypersupply phase, bonds are where you want to be. Bonds at this time here where you start to roll over. So you go back over, you go under that average that we were talking about here, your long-term occupancy average. You want to be in bonds here. Usually you get a large contraction or blowout to the downside. These are generally the preferred areas. You start to come in under this trough here. If they stimulate, you want to go back into gold. That is one full cycle. There's other things that people refer this to. They consider it the four quadrants, where we can look at these four quadrants and figure out where exactly to invest in based off of the quadrants. So if we were to look at it, you can see this, and it's just labeled a little bit different. Rising inflation, slowing inflation. This is your recession. your recovery phase, your expansionary phase. This is your late cycle hyper supply phase where you're about to crash. So if you were to look at this and you were to look at how they labeled what does well, in a recession, you want long duration treasuries and gold. You want to buy that at the top here as it crashes back down. If you go into the recovery phase, developed real estate, developed equities, intermediate treasuries, developed corporate bond spreads, that's what does well at the bottom of kind of a recovery phase. As you go into an expansionary phase where inflation kicks up from that credit expansion, you want to be inflation protected bonds, emerging bond spreads, gold, commodities, international real estate, and emerging equities. As you go late cycle, that's going to turn into gold and commodities, emerging bond spreads, and inflation protected bonds and cash, because you're preparing for a potential crash. And that crash, where I'd want to be, is long duration treasuries. You can see gold is in three of these quadrants. And you can tell with physical metals, they may perform in every single one of these three quadrants here. So it's not as easy to be swapping. You have to time it more using technical analysis and the ratios. So we kind of know what does well where, based off these two areas. In my opinion, where we are today is we're entering the expansionary phase of real estate. This is where we have very low inventory and where we need to build more homes. There is an aspect of affordability that a lot of people are worried about, and that the expansionary phase of real estate could slow down based off where interest rates are. And that is true. It is possible to slow it down, but I don't know if it's possible to completely and utterly stop the cycle in its tracks. History has shown that it has not been able to do that. Interest rates has not been able to completely stop the cycle, and that the cycle almost always prevails until there's a hypersupply phase and that the markets are balanced in whatever term. So the demand and supply is balanced in the real estate market. So the way that this works and the way that my strategy is deployed is you take where we are in these cycles here, and as you go from one to another, you want to make sure that you're buying the undervalued assets. So let's say commodities are undervalued. The way that you do that is I'm basically using what Buffett and a lot of these other people do in terms of value investing. So this is the strategy that's basically implemented. We take our technical analysis and we apply it to the ratios. I can do that here real quick just to show you as an example as we walk through this together real time. So I'm just going to use uranium versus silver here, okay? Well, if this is history and this is back to the last bull market, the peak of the last bull market, uranium was priced to silver at a ratio of about 11 as the peak. We went down into a gigantic selling recession phase of that real estate market, and commodities are not favored during that time frame. So this is your recovery phase here. This is all your recession is where it came down from 2009. This is from your recovery phase onward. This here is a bear market in commodities. What that is signaling is that uranium does not do well under that market condition. If you were to look at that and go back to the deal here, commodities are not good during this section here. They crash. And that is exactly what we're seeing. So you can literally look at this uranium to silver ratio and say, look, we're in a recession here. And silver went way up in 2009 and 2011. And you can see that uranium underperformed silver. That is where silver outperforms. You want to be in silver during this outperformance. And then you want to swap down here at the bottom. Just like I said, generally after a crash where you want to be in bonds. So if you were to look at this and tie this together, you want to be in bonds up here and you ride it on down. Then at the 09 level here, you want to be in silver as it bottoms. Then silver still outperforms. And you want to be out of silver in about 2011, 2012. That's where you want to go buy your technology stocks. That's where technologies do well. This point onward, at about 2019, 2020, this is where you should be looking for commodities. They're bottoming out and they're about to make their big move. This is also another way to determine where we are in the cycle. Because if you know and you're an expert on market conditions, you know that certain commodities outperform during certain periods. So uranium, which we're entering an outperformance here, guys. Look at uranium breaking out against silver. What this is telling us is that we are in the phase, if we were to tie this back, we are in this phase where energy and materials outperform. We are at an expansionary phase here, and the outperformers are about to be energy and materials. How can I make that claim? Well, the way that I can make that claim is that uranium is about to outperform just about everything. And energy, which is included, uranium's included in energy, is about to outperform everything. So we can state that that is where we're at in the cycle. So we're moving on up for uranium against silver. We're moving on up uranium versus the S&P 500. Look at the breakout there. Uranium's about to outperform the gold. Uranium's about to outperform, well, crude oil and uranium, they're going to go back and forth. I don't know if there's going to be an outperformance there. Uranium versus copper, outperformance for uranium. We're just breaking out. Uranium versus nat gas. This is going to be back and forth. Uranium versus Dow Jones. We're just breaking out here recently. Uranium versus platinum, which is breaking out as well. So that means that we are at that phase. We can also look at crude oil. Crude oil to gold. We can see that this was just broke out and it's going to outperform here. So we've got further evidence of that occurring. Here's your consolidation zone all through this. That's all consolidation there. And we've got crude oil versus Dow Jones. You can draw a downtrend line, something like a downtrend line like this, where we've broken out, did a retest, and then we're starting to break and move our way up. This is also a double bottom, and we're going to move all the way up, I think, to very ludicrous levels to the upside, based off for a variety of reasons. So we have a long way valuation runway for all of these. Everything that I've just showed you has a gigantic runway for uranium and for crude oil and nat gas. All the energy stuff has a very big valuation runway. So we go back to our deal here. We've gone through that. The way I'm doing this is we're looking for this bottom buy zone. And I just described to you using ratios what that buy zone looks like and how we're breaking those bottoms. The value or the intrinsic value of a company, they put a company here, but think of this as the historical average based on time. And this can go sideways or it can go slightly higher with inflation. This could be your value of, or the price of the commodity. And the commodity goes up above it and below it based off of the market conditions. The market conditions are what are flowing these things back and forth. The market conditions are determined by the real estate. Commodities do well in this expansionary phase. It's the energy and materials here. And that is what we're doing is we're at the beginning of an expansionary phase. We're at the buy zone of these certain commodities, and we're giving ourselves a large margin of safety off of history of what these commodities and assets should be valued at. That is what we're doing. But you have to have the correct time frame to make sure that this can actually go up. So that usually takes years. It doesn't take weeks. It doesn't take months. So we've got our long-term historical average is the orange line. And if we were to look at this and look at it from a different perspective, this here's your commodity bull market from this bottom here to the top. Your intrinsic value could be this, let's just say, and that is adjusted for inflation, just hypothetically speaking. We had a large inflationary boom over here, and then the market participants pushed this from an undervalued state to an overvalued state, or an underpriced state to an overpriced state. This is a changing market condition, which is a recovery phase. And we went into a recovery phase where these don't do well, and it went to an underpriced area again. The cycle goes from underpriced to overpriced to underpriced. And that is based off the market conditions. Your business cycle is what this is doing. And it's moving through this cycle where energy, if you were to look at this, energy would be cheap here and expensive here. And that's that part of the cycle you should be playing energy with. Then you go into something else, which would be bonds to potentially gold if it's a stimulus-driven cycle. If there's no stimulus, then you want to prefer real estate at the bottom here. Then you go into real estate or something on the likes of that. Then you swap into tech stocks at the bottom here, somewhere in this recovery phase. And that's generally where they do very well. This is the whole strategy, though. You want to buy with a gigantic margin of safety, something that's underpriced, that has the technical chart patterns where all these are giving us buy signals in the market. And if I were to go back to some of the buy signals, we can look at stuff like XOP, and we look at this, and what we have is your boom phase happened and occurred back here. This is a big topping pattern. It's your Batman pattern that just looks a little bit weird. And then we go into a recession, which goes all the way back down. This is a recession here. It bounced back up, but we went into recession, recovery phase. It bottomed here. What we have is an inverted head and shoulders. It's the shoulder, head, shoulder, which is a bottoming pattern for a big move to the upside. We want to see that we're getting these bottoming patterns technical wise and lining that up with our where we are in this phase. So we should be seeing energy put in bottoming patterns if we're here on this right-hand side here or left-hand side here. That is also more evidence of where we are in the cycle because all of this is interconnected. It's not one thing or the other. It is this big interconnected piece where every single piece of data that we are obtaining from the markets is telling us where we are in this cycle. And a lot of people don't understand that. They just think that these things are randomly going up. No, that's not the case. We are at this beginning expansionary phase because of the evidence of this putting in and breaking out of a bottom. Because of all of those ratios that I showed you where uranium's about to outperform and where crude oil is about to outperform stocks. All of that information is information that is telling us where we are in this cycle. And energy, although it's performed really well, in my opinion, is not, we haven't even started this move yet. This move is part of a bottoming pattern here. And this move, where we came all the way down here, is a fictitious pullback from a stopped economy. So in my opinion, this move here was just a pre-game to the real game because the expansionary phase of real estate isn't the driver of it. The driver of this move was a shutdown in the economy that was created by man. And this move here was a move back to where I consider this to be reality. So we're back to the beginning of the bull market in commodities, in my opinion. And that the bull market is about to, the real one's about to start. This here was all a perfect entry point because the real estate market didn't drive that. It was man-made and there was stimulus and all this other crap that was put in that. So it's all telling us where we're at. And it gave us certain buy areas or buy zones. The buy zone is your ratios. That is what is determining it. That is your value. So I am extracting the value of the commodity or sector given time. Your buy zone is based off of the ratios. So if I were to look at this and I were to go to a commodity to stock ratio, this is telling me where we are in the cycle. This is your expansionary phase of real estate. This is your crash in real estate here. This is your double top, so to speak. And then we went all the way down in the ratio during a recovery phase. Why did commodities go down like that? Because commodities in a recovery phase are not in cycle. So if we were to look, they're not in cycle over here, guys. They are out. They are not in cycle here. They're not in cycle here, and they're not in cycle here. We are not in the commodity cycle during that period. And money flew out, it came out of commodities and went into stocks, the S&P 500. But guess what we have now? Like I said, we're entering an expansionary phase, and now commodities are going to outperform the stock market. And this is the evidence of why I think so. Remember that valuation chain. If the average value is somewhere in here, we want to buy commodities down here in this inverted shoulder, head, shoulder, and then the breakout. Then we want to buy commodities here, which is another hypothetically inverted head and shoulders, which is probably going to break out. And I'm just showing you guys roughly, the bottoming patterns that I'm seeing. Then we're going to have a large outperformance that's about to come in commodities. Now, I can tie this ratio chart with a bunch of other commodity companies that are putting in bottoming patterns. Now, here's the thing, guys. They're all putting in bottoming patterns. The supply and demand are not based off of the physical commodity itself. Yes, there is that. But what I'm talking about is financial money flows. And the financial money flows are overwhelmingly huge and make the bigger difference than the supply and demand of its entirety based off of this cycle. And the reason is that when you're out of cycle, some of these investments drastically underperform. And it forces the individual that's holding those companies to literally sell their asset and move it to something else. It's the market forcing pain onto the individuals that hold some of these assets. And eventually the people will cave in and give up and transfer it to something that is in cycle. They're going to FOMO into price performance. That is what they're going to do. So that is what we're doing. We're identifying the market conditions based off the real estate cycle, and we're buying the underpriced assets with the chart patterns that are exhibited in the stocks that we want, and we are selling these in an overpriced environment where the market conditions cease to exist. That is how this strategy works. Now, why value investing works? Value investing works over the long term. You have to take a long enough time frame for the valuations to actually change against each other. This isn't something that is swipe left or swipe right. This is something where you have to conform to the markets, and the speed of the markets is what you need to adopt. So it says, take a simple idea, value investing, and take it seriously. Then it says, everyone is a value investor. If you can keep your head when all about you are losing theirs, you'll be a man, my son, says Kipling. Value disappears because the market conditions change over periods of time. Then the value investors disappear because you need to sell it when it's overvalued. That is how this cycle works. They all show up here for the value investors, and they all disappear when it's expensive. And it's based off of the market conditions and how money flows between all these different assets. The value is created by the market condition that you're in. And all you're doing is you're front running the money flows. If energy is hot materials, eventually you're going to swap to perhaps healthcare or consumer staples or utilities. The problem that a lot of people, I think, have with this cycle is it's difficult to tell where we are in the cycle because of the stimulus money that was put into the system. It is giving false signals, I think, from the inverted yield curve. We could have a slowdown from all that stimulus. We'll call it a stimulus overhang, where yields have to come back down to kick back on the real estate market to, we'll call it a hyper supply phase. That is a possibility. It may not need to come back down, the rates. We'll see. We'll have to monitor it and watch the inventory levels and watch new housing starts. Those are all things that we can watch that are leading indicators of where we are in this cycle. So value investing, to sum it up, what we are doing is we're giving ourselves a big margin of safety. We are buying it when it's bottoming out, the ratios compared to history. And this is being created based off the real estate or business cycle. And again, it says buy when Mr. Market offers the business at a discount to fair value. That discount is being afforded to you or allowed for you to buy that based off the market condition. Then when the market price goes back up, you sell it when it's overvalued. This person, they had put down different market conditions that people are subject to: financing, interest rates, asset prices, inflation and deflation, the capacity, the inventory levels, competition, business models, consumer demand, business demand, employment, procurement, taxes and regulation, and stability. Those are all different market conditions that have an impact to the way that people behave in a system. People behave different when interest rates are low versus when they're high. They behave different when certain assets are going up and when other assets are going down. Inflation and deflation have an impact on interest rates, and some of these are interconnected. So that is how I view the markets. That's more information of how I'm viewing it. And right now, if you were to look at everything, commodities are in cycle. So what does that tell us? We're in an expansionary phase of real estate. So they are interconnected. Everything in the market is interconnected, and it's just money flowing from one asset to another asset based against history. And we can see these valuations based off the ratios and comparing those ratios of an asset versus an asset. If we divide the two assets against each other and compare it to history, we can see where the money is, where it isn't, and where it's flowing. It's flowing into commodities right now based off where we're at in the cycle. And we can validate where we're at in the cycle. We're in an expansionary phase of real estate in this cycle right now. How do I know that? Low inventory, increasing housing starts, high interest rates. Those are all interconnected. They all scream expansionary phase. How do I know I'm not in a hypersupply phase? We haven't built the homes. There's no inventory. And that's how I stay level-minded of where we're at in the cycle. There's no inventory. You can't be in a bust phase at the same time you're in a shortage. Make sense? At some point, if we're in a bust phase, if we do have foreclosures, if there's forced selling, your inventories would go up. And we would see it in the inventory levels. We're still in an expansionary phase of real estate until we're not. So that's where we're at in the cycle. That's how I'm viewing everything. And that's more information of the strategies that I'm deploying. Now, I also look at fractals. Fractals are repeating patterns over time. It's the genetics of the markets. The genetics of the markets is much like your hand, all right? If you were to see a fractal and you were to see the first move off a bottom, the size of the move, if you were to look at Fibonacci sequences, and I know I'm going a little bit more advanced, but if you're looking at Fibonacci sequence, the first wave is going to be an indicator of how big the third and fifth wave could potentially be. They generally link up pretty well. And I'm using certain fractals and the size of the fractals to determine which companies have the most leverage for the move in the future. And the moves in the future obviously are projections. They're not perfect. But generally speaking, you can figure out wave 3 from wave 1 and which companies we should be overweighting versus underweighting based off those fractals. You're also going to have to look at other things like cash flow. Is it speculative? How much do I want to speculate? How much risk do I want to take on? So you need to be, there's two things you have to master if you want to be a really good investor and you want to maximize, quote, the velocity of these things. You need to master this cycle. You need to master where the money has to be and what does well under what market condition. You have to be very good at ratios and technical analysis, basically to sum this entire thing up. Then you're going to have to know what vehicles are best for you. The vehicles are what I'm describing with these fractals. What has the most leverage to the price moves? How do I weight these things? How much risk am I willing to take? Is the risk worth the frickin' squeeze? Look at the risk reward levels. Maybe some of these companies aren't worth the risk that you're taking on. Then you have to look at and say, okay, when do I switch to something else? What do I need to look at? Is it overvalued? Is it cheap? Is this next thing I'm going into cheap? What's the risk reward of the next asset and where we are in the business cycle? If we're towards a crash, well, you better be in gold or long duration treasuries. That's where you want to be. Now, when do you move? Well, that's what you're going to have to figure out. How do you got to be an expert in the business cycle, the real estate cycle? Do you have inventory? How are the housing starts going? What's unemployment doing? They should all be interlinked. The construction cycle and unemployment are linked together. they're one of the same thing. Because when housing starts go down, everything else, you'll see layoffs in construction, you'll see layoffs in all these different things, and it feeds through the entire economy, which then you get a slowdown. We don't have that at this time. So I don't know what these people are looking at for a potential recession. I'm assuming that they're guessing that the high interest rates are going to have an impact with non-real estate stuff, where it's going to rampage through some businesses or something like that, and we could see some foreclosures there, or bankruptcies or whatever it is in commercial real estate and those businesses. But that's the cycle, guys. And in my opinion, and where we're at, energy's ready to go. And remember, gold worked on 3 of those quadrants. Gold generally works very well where we're at. It's generally a pretty good spot to be looking. It just hasn't taken off yet. You got to be patient for that to take off. That is where you got an exceptional investor versus someone who's impatient and a newbie that doesn't know anything about any of these cycles. So that's what we've got. Again, if you want to learn this, if you want to figure out where I'm investing, what companies I'm investing in, I think I have a pretty good handle on what companies will give you the most amount of leverage, the best risk reward, and all that stuff. Even for certain people, I can get you in certain areas of what those companies should be. But sign up to finding-value.com. Oh, there it is, backward in the camera. And we do have a September discount code, 50% off the first month, if you want to join our community. Our community is a bunch of people that are like-minded, that want to conquer this investment landscape using this business cycle and the real estate cycle. That is our strategy. It's not 100% technical analysis, but there is a lot of technical analysis involved. It's a lot of buying, accumulating at certain areas based off of ratios and a little bit of long-term technical analysis, and then being really patient and waiting. This mastering this cycle is I think probably going to be one of the most rewarding in terms of percent gains per year that you could potentially ever find in the market. You're still going to have years that go up and down, but you're going to have very big up years, and your down years won't be nearly as bad or as large as the regular investor. So that's the strategy, guys, and that is what I've adopted, and trying to put it into visuals so everybody understands what I'm doing. This is something that may have existed before I basically found it myself. I looked at the data backwards, and this is basically how I came about it. And I'm obviously learning more as time goes. I'm refining, just like any engineer would. The approach, the strategies, and the things that I would bring in front of people to show you guys. But that is, I would say, the strategy there. And can you increase the velocity? You can. You can also do it by increasing a little bit more risk and going after larger returns. It's possible, but there's also downsides to everything. The more risk you take on means that the eventual outcome may not be as desired, because the risk may actually be realized, we'll call it, and maybe you miss out on something. But that's also why you have a portfolio and a diversified approach. The metals are the least risk way to play it. The metals right now are obviously out of favor, going into favor, and that's one spot that I would definitely be in. Why would someone choose physical metals over stocks? Well, physical metals have a bunch of properties that stocks don't have. Stocks have a third-party risk. They have risk because you hold them in a brokerage account. Physical metals, that's completely out of the system. And it's completely different, and your tax structures and all that stuff is different as well. Obviously, I'm not a tax expert, and I don't want to talk about taxes, but everything's out of the system. There's things that you can do with like kind exchanges and all sorts of stuff as well. And then you can do some sort of these exchanges depending on where you hold these assets as well. So that's what I've got, guys. I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Join our community. Learn this stuff. Become a better investor. We also have. You can see my portfolio. You can see the picks that I have for myself, and you can follow along with those if you'd like. I give a lot of opinions around those companies and those picks. I give you a little bit of details about the company itself, why I think it's good. Why some of these are really big dividend payers. 20-30% yields on some of them that can pay out for the entire commodity bull market. So there's a lot of really good investments, I think, that we are covering in this community here. And obviously there's people who bring up really good investments as well that we help each other out in. So, all right, guys, that's what I've got for today. We'll catch you later. This is Finding Value.